Hey everyone, if you're a long-term investor, if you invest in things like shares or you want to invest in things like shares, if you're a high income earner and have huge surplus cash flow, or you've got investments that generate cash flow, you have to make sure you pay attention to this one. It's a really key principle to long-term successful investing. Now it is general advice in nature, so remember it's not going to apply to everybody, but if it does apply to you, feel free to explore this, or if you're not too sure, reach out to your advisor, reach out to me, more than happy to guide you through it in a more personal way. But this concept is called dollar cost averaging. It's really important. It's something that we do on a regular basis at Hewissons, and it's a really incredible function that allows you to take advantage of market movements. So the whole idea is you might own a certain investment. Now you might really like that investment and you want to hold it for the longer term, but due to whatever has happened in the market recently, the price of that investment might have fallen. And most of the time we use dollar cost averaging in the share market because you can buy and sell on a daily basis, Monday to Friday. So the best way to explain it is to use an example. Let's say you own shares in a company and you bought those shares for $10 each. And the phone rings. And the phone rings. Let's say you bought these shares for $10 each and you bought 100 of them. So you paid $1,000 to buy shares in a good quality company. Now that good quality company, you might still really like it, so you want to stay invested in it, but it might have fallen, say, by 20%. So shares are not worth $10 anymore, they're worth $8. Okay, that's all right. You can withstand a bit of volatility because you invested for the longer term. Great. You have faith it's going to recover, and hopefully it does. So do you just hold on? Do you just sit on those shares and wait? Or do you use some of the excess cash flow that you're generating from your portfolio or from your employment circumstances and buy some more shares at $8? Well, you might decide to go and buy another 100 shares at $8. Well, because you bought half of your parcel at $10 and half at $8, the average cost has been dropped down to $9. So you started at $10, it now costs you $9 per share on average. What does that mean? Well, it means when the recovery comes, you're going to be in profit territory anytime it reaches $9 or above. If you had just waited, then what you have to do is wait until the share price gets to $10 until you're back where you started and start making a profit. So buying extra shares when it dropped in value, or dollar cost averaging, reduces your cost price per share when you average it out, meaning you get back into profit territory a lot sooner. It's a really important function. Once again, it's what we do on a daily basis, and any quality advisor will be making sure that they dollar cost average into great quality investments. Super important principle. I hope you can utilize it at some point. Remember, if you want any kind of personal advice, just reach out.